To take us through the results and to answer your queries, we have with us today Mr. Rajesh Subramaniam, our MD and CEO, and Mr. Dinesh Jain, our CFO. We will be starting this call with a brief presentation providing an overview of the company's performance, followed by a Q&A session. Before we begin the call, let me remind you that some of the matters we will discuss on this call, including our business outlook, are forward-looking and as such are subject to known and unknown risks. These uncertainties and risks are included but not limited to what we have mentioned in our prospectus, filed with SEBI and subsequent annual reports that are available on our website. With that said, I turn the call over to Mr. Rajesh Subramaniam, our MD and CEO.
Yeah, thank you, Ankur. Good morning, afternoon, and evening to everybody on the call today. Let me take you through the summary of Q4 and FY18 and some color on the outlook that we have gazing into FY19. Operating revenues in Q4 fiscal 18 came in at 897.3 crores compared to 887.2 crores in Q3 FY18 and 892.3 crores in Q4 of FY17. Quarter-on-quarter growth is 1.1% in rupee terms and flat in constant currency terms. Year-on-year growth of 0.6% in rupee terms and growth of 0.5% in constant currency terms. Pro forma the domestic business out, which we sold in August last fiscal. Then the year-on-year growth is 6.9% in rupee terms and 6.7% in constant currency terms. Operating EBITDA, Q4 operating EBITDA at 132.5 crores compared to 116.1 crores in Q3 18 and 99 crores in Q4 FY17. Quarter-on-quarter growth of 14.1%, margin expansion by 168 basis points from 13.09 to 14.77%. Year-on-year growth of 33.8%, margin expansion by 367 basis points from 11.1 to 14.77%. Pro forma the domestic business out, the 33.8% growth would have been 40.6% year-on-year. Operating EBIT came in at 115.3 crores in Q4 of 18 compared to 99 crores in Q3, the sequential quarter in Q3 FY18, and 88 crores in Q4 FY17. Quarter-on-quarter growth of 16.5%, margin expansion of 170 basis points to 12.85%. Year-on-year growth of 31%, margin expansion of almost 300 basis points from 9.86% to 12.85%. The growth would have been 36.5%, excluding the domestic business in both the periods. Profit after tax came in at 92.8 crores compared to the operating profit after tax of 75.5 crores in Q3. The reported profit after tax was obviously 99.5 crores because of the deferred tax benefit we got because of the tax change in North America, which gave us a one-time benefit of 24 odd crores in Q3 of 18. In Q4 of FY17, the profit after tax was 65.4 crores. So quarter-on-quarter growth of 23% on operating PAT, margin expansion of 184 basis points from 8.51 to 10.35. On reported PAT, it's been a degrowth of 6.7% and a reduction in margin of 87 basis points. Year-on-year, the growth is 42% and margin expansion of 302 basis points from 7.33 to 10.35%. Excluding the domestic business, the year-on-year growth would have been 50.1%. Really happy to note and mention that the board declared a maiden dividend in the history of this company. This would be the first dividend of 15%, which would be approximately 38% of the profit after tax, including DDT. Moving forward, the highlights for FY18. Operating revenue at 3,535.2 crores compared to 3,555.6 crores. While there's a degrowth year-on-year of 0.6%, the growth in constant currency is 2.8%. Excluding the domestic business, the rupee term growth would have been 3.7% and the constant currency growth would have been 7.1%. Operating EBITDA at in FY18 of 458.9 crores compared to 438 crores in FY17. The growth year-on-year is just under 5%, margin expansion of 66 basis points from 12.32 to 12.98. Performing out the domestic business, the growth would have been 8.9% year-on-year. And on a constant currency basis, the growth would have been 15.2% year-on-year, and the margin expansion would have been closer to 1%. Operating EBIT at 393 crores compared to 379 crores in FY17, year-on-year growth of 3.7%, margin expansion of just under 50 basis points from 10.66 to 11.12. Excluding the domestic business, it would be 7.5% year-on-year, and the growth would have been 14.3% year-on-year and a margin expansion of 80 basis points on a constant currency basis. Operating PAT at 302.4 crores compared to 280 crores. Year-on-year growth of 8%, margin expansion by 68 basis points from 7.88 to 8.56. The same number would be 13.4% year-on-year excluding the domestic business. The growth would be 22.6% year-on-year, margin expansion of 120 basis points on a constant currency basis. On a reported PAT basis, 326.5 crores compared to 280 crores, and that represents a growth of 22.2% year-on-year. We repaid 61.7 million of debt in FY18. There's been a complete closure of $135 million term loan, which was in our U.S. books, and a $20 million ECB. Last year, we also successfully divested our domestic business, which has been a big highlight and sets us up well for margin expansion next year. Other highlights, headcount of 18,703, 8,810 employees in India, 9,894 based outside of India. We had a reduction of 523 employees. Some of them related to our larger client, the largest client that we have, where there was some portfolio rebalancing which happened between their sales and service estates. Attrition details came onshore, US and Europe, 47.3% compared to 39.4% in Q3. Offshore, India and Philippines, 46.6% compared to 39.4%. Nothing exceptional here. It's a seasonal uptick. Nothing that worries me at this point in time. Net long-term debt of 27.4 million as of 31st March 2018. This would become practically zero by the time declare our Q2 results in FY19. From FX hedges, exchange hedges perspective, outstanding FX hedges at 71 million for the dollar and 107 million for the pound. For the next 12 months, 58% coverage of the INR USD at 70.7 levels, 62% coverage for the pound at 101.1 levels, 38% coverage for the dollar Filipino peso at 51.7 levels, and 73% coverage for the pound Filipino peso at 68.6 levels. Ensuing 12 to 24 months, 61% coverage for the dollar at 69.8, 71% for the pound rupee at 99.2, and 25% for the pound peso at 72 levels. Post 24 months, 83% coverage for the pound at 108 levels. Slide number 7, it's basically a tabular representation of what we have discussed right now. It just shows Q4 EBITDA of 14.8, probably one of the highest that we've seen in the recent past, probably in the last 5-6 years. Operating EBIT at 12.8% has done well. PAT at 10.3% has obviously at 92.8 crores has on an operating PAT basis again is one of the highest in the recent times. From the perspective, all the numbers look largely flat, but the key to note here is performing out the domestic business. Constant currency growth has been 7.1%, which is right at the midpoint of what the industry growth has been, and margin expansion of 60 plus basis points, which is what we had committed to in Q1 of last year when we saw the outlook for the business in FY. Q4 revenue snapshot. North America continues to be the principal markets, 55.6% of our revenues, 43% from the UK, and of course we have one customer in India, which is in the banking field, which shows up as 1.2%. From a vertical perspective, largely equally distributed among all three. Healthcare being first among equals at 37.6%. T&M and BFSI are largely at 31% each. From a revenue by delivery perspective, 77% onshore, 23% offshore. By segment perspective, customer interaction management services, 53.5%. This also includes our mortgages business. Is consolidated under customer interaction management services, while the work is more origination, platform-based origination and servicing work. Healthcare 35.2% and collections 11.3%. From a client concentration perspective, top client has reduced between Q3 and Q4 from 29.2 to 27%, which also has a direct reflection on the top 5 clients at 45.1%. Nothing that I'm worried. As I said, there was a portfolio rebalancing, which saw some elements of the sales estate headcount reduction, and we expect once the EPL season starts, it should be in our Q2, some of these numbers will start coming back up again. FY18 revenue snapshot. Again, I won't spend too much of time on this. The only call out I have here is the fact that the revenue by verticals, healthcare and T&M are the two big ones. BFSI 29.2, but in Q4 we saw the BFSI vertical typically is higher because of the collection seasonality, where most of the clients are banking clients. And revenue by geography 2.8% reducing to 1% with a reflection of the reduction in the domestic business, which we divested in August, so hasn't been with the company for the first 7 months of the fiscal year. Revenue by client concentration, top client increased from 22% to 28.3%. Revenue by delivery, offshore 76% and onshore 76% and offshore 26%. So let's spend some time on the business outlook now that we've done with historical facts. Growth momentum is looking very good for 2019. Constant currency revenue growth will be at the top end of the industry growth rates, or my sense is could be higher than industry growth rates. The deal pipelines that we have, the deals that we have signed, very encouraged. Evidence of this will be seen in Q1. I mean, Q1 seasonality fall-off usually ensures a muted quarter compared to Q4, but you will see growth evident in Q1. And Q2 is where the deals that were sold last year start getting into BAU mode, and you will see a clear step up from Q2 onwards. So very, very bullish about where our growth rates will end next year in relation to where industry is expected to be. Healthcare and BFSI would lead the growth rates in FY19. Significant transformation-led revenue acceleration will be evident across healthcare, specifically across both the provider and payer space. In BFSI, clearly see some of the deals we've won in the customer interaction management space, specifically in mortgages, which are driven by significant RPA and machine learning-driven RPA. Transformation-led growth, sales pipeline accretion also has been pretty close across both BFSI and healthcare. Margin expansion will continue in FY19, and ladies and gentlemen, remember this is margin expansion from where we ended FY18 with. So 60 to 80 basis point improvement in margin. Expecting us to get to a 14% EBITDA levels is not unrealistic in FY19, which takes us closer to some of our peer group which are listed in the U.S., so who are in the 15 to 17% range. So again, divestment of domestic business, transformation-led growth, where transformation-led gain share and operating leverages provide continuing tailwind for margin expansion. So overall, feeling very good about FY19. Q4 FY18 could have been better, but for the portfolio rebalancing with our largest client, but it's a temporary phenomenon. While, as I mentioned in the last quarter, that the top client, it would be flat or it would be slightly with a downward bias. That's the same outlook we have with our largest client for based on the guidance we have. But the portfolio of other businesses which are growing, especially in mortgages, healthcare, and the banking business within the customer interaction management services business is very encouraging at this point in time, which leads us to believe the guidance that we have given you. That's all I had at this point in time. I'm happy to hand it back to the moderator to open it up for questions.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Amit Goela from Rare Enterprises. Please go ahead.
Yeah, hi. Thanks for the opportunity. Rajesh, many congratulations to you and your team to come back on the dividend list. Fantastic achievement over the last 4-5 years.
Thank you, sir.
Yeah. So very good to see you guys back on the dividend list. And number 2, going forward, while you gave a fairly bullish outlook, Rajesh, 2 questions. Would you like to put a number to that growth number, like when you said like you might exceed or match or exceed the industry growth? Would you like to put a number on that? A. And B, with the way the currencies have strengthened now, the pound and all that, so while you've given your hedges, like what kind of impact it might have on the business?
Yeah, excellent point, Amit. I think to put a number down, I think a 9 to 10% growth next year. This is the reported results. Now, if I pro forma that for the ABU, because ABU business last year also was there for 5 months, the growth rate will be closer to about 12% year on year, which is far exceeding anything that the industry today is looking at. Similarly, on the profitability, the year-on-year profitable growth in Q1 between Q1 of FY19 and Q1 of FY18 will be in excess of 25%, which will give you a sense of how we are set up, as we look at FY19. So, and again, on the hedges, ours is a 12 to 24 months, 0 to 12 months and 12 to 24 months. So on the offshore book, whatever we have hedged, it's roughly between 60 to 80%. So any growth that comes in right now, there will be benefits on the pound because, when the pound was 85, the forwards were closer to about, 90, 91. But the pound being spot at about 90, 90.5 right now, the rates are about 96, 97 for the next 12 months. So, and our unhedged portion is about, roughly, probably about 20, 25%. So, But obviously a big uplift is on the dollar. Similarly, on the consolidation side, at this point in time, if the pound and dollar hold where they are to the guidance we have given, there could be some upside, but those are translation related. So, the numbers I've guided for are on a constant currency. There could be translation-led increases that we could see if the rupee continues to remain weak through the year at the current levels on both the dollar and pound.
Thank you, Rajesh. Thank you so much, and all the best.
Thanks.
Thank you. Any participants would like to ask a question at this time, they may please press star and 1. A reminder to our participants, if you wish to ask a question at this time, you may please press star and 1. The next question is from the line of Mohit Jain from Anand Rathi. Please go ahead.
Hi, sir. Anything on dividend for FY19? Like you guys will be having cash, and I'm assuming that is already repaid. Anything on capital allocation that you have thought through and would like to discuss?
I think, a 35 to 40% payout of PAT is something which the board debated on, which we are comfortable with. I mean, for IT companies, obviously it's a low number, but we'll step it up. And, if you honestly take a look at it, we've been paying about $47, $48 million between principal repayments and interest repayments every year. We will become net debt, long-term debt zero in October. So, if you take a look at $47, $48 million and roughly I allocate 50% towards dividend and 50% towards M&A, 50% will translate into about $25 million, which roughly works out to the dividend levels that we have currently announced. So that's the thinking right now. But going forward with the accretion in profits, the policy would be somewhere between 35 to 40% payout of PAT. Including
40% from FY19?
Yeah, from FY19, yeah.
Okay, second, on the acquisition side, your guidance includes anything on that front because you're already allocating 50% to be used for acquisition or?
Nothing. No, we have nothing on the table right now. We're looking at several targets across several businesses. Nothing which is even close to a non-binding LOI at this point.
Okay, the third thing is on the currency. So in the PPT we have seen you have almost 80% on-site proportion of work. So with 80%, your ability to benefit from rupee depreciation would be a little less compared to other companies.
Yes,
is that a fair assumption or?
No, absolutely. So earlier, as long as, our loan book was there and principal and interest repayments were happening, the cash flows were a natural hedge towards the foreign currency payments. And at this point in time, the contribution, for example, the healthcare business generates a 15% EBIT margin. So, 15% on $230 million. The only thing that if we decide to downstream the cash into India, that's where we will look at the hedging gains. So, but apart from that, you're right. The benefit we have is on the delivery book in India, which is roughly about 22-23% on our 550 million revenues.
So it basically doesn't impact your earnings guidance, so to say?
No, it doesn't impact my earnings guidance. The only where it will impact is if the rupee depreciates further. On consolidation, there could be some gains in rupee terms.
Right. And lastly, on the taxes front, like your U.S. taxes have naturally come down. So any planning on that front? What should we expect for FY19?
I think as we guided last quarter also, after the U.S. tax rate dropped down to 21%, we expect, I think they should be in the range of 17-18%.
17-18 for this year?
Yeah.
And similar rate for 20 as well, right? Because
I think at least next 2 years probably we should range between that.
There is no question of you going up beyond that, right? Like 21, 22.
As of today, unlikely, because you really see UK tax rates are 19%, US at 21%, and India we got SEZ, so we do have tax benefits on that. I probably don't see much change happening in that space.
So 17-18 should be the steady state tax rate for us. And lastly, sir, on the CapEx side, anything to be added or CapEx will continue to be low for us?
CapEx will be in the $10 to $12 million range.
See.
Yeah.
Okay, sir. Thank you. That's all from my side.
Thank you.
Thank you. The next question is from the line of Rahul Jain from Emkay Global. Please go ahead.
Yeah, hi. Though you have shared some bit of color in terms of where you're expecting this growth, but if you could share in terms of what is driving this thought process and how this growth compared to the real peer set for us. I mean, we have benchmarked it to our this industry of NASSCOM growth or something, but what is the real benchmark for us and what is the growth for that industry from a like-to-like basis?
No. I mean, we don't benchmark each industry. NASSCOM comes with the overall industry growth for the BPM industry. That straddles verticals, horizontals. It straddles the entire industry, which is at large. So the growth rates we're saying, the alpha drivers for us, the alpha and beta are going to be mortgages. It's going to be BFSI and healthcare. Within BFSI, it's going to be mortgages. Within healthcare, it's going to be the healthcare provider business. So these are the two big principal drivers of our growth going forward. In the customer management business, as I said last time, the growth rates is going to be again being driven by banking, because we have only one T&M customer, two T&M customers, and there, as I said, it's going to be more of a little downward bias than an upward bias, and the growth is going to be driven by the BFSI segment. Similarly, collections, the financial services collections, the Department of Education, which had shut down in FY17, has come back again towards the latter part of FY18, and that will drive growth going forward. The financial services portfolio will largely remain stable, with some upward bias from some of our clients who are consolidating existing vendors, and we will be a gainer from a market share perspective. So as I said, overall these growth rates that we have projected are superior because of the deals that we have signed, and when we benchmark ourselves to our peers in the industry.
Okay, and when you say, margin possibility, improvement of margins possibility, and in light of the billing rates and pricing that we might be seeing in the market, so how much volume growth and how much would be pricing growth when you build this guidance for the next year? And if that is the case, what is the real operating leverage for us from a margin uptick perspective?
Yeah, as I said, in our business, volume, there is traditional volume and there's transformation volume. So, margin expansion for us is happening because there will be certain parts of a portfolio where there will be a revenue reduction, but profit accretion. So that's that's a smaller part of a portfolio. And, going forward, probably from Q2 onwards, we will be disclosing, what our transformation-led growth is and how that plays out into how you will clearly start seeing the margin accretion happening, from Q1, Q2. At that point in time, it will be easier for me to tell you, what is the volume decline, but profit increase, and what is the absolute volume increase, which sets itself up for our transformation 12 months once the business is stable, and then the transformation ensures that there is a productivity improvement, which then drives a higher margin profile. So that's how the whole cycle of the engagement with clients is shaping up. So, as I said, we're looking at a 14% EBITDA margin. That's about almost 100 basis points year on year. While we've guided for 60 to 80 basis points, a 14% number doesn't look unrealistic on the back of growth, which drives operating leverages, and transformation-led, which is more outcome basis, where the gain share ensures a margin accretion for the same effort provided.
Understood. That's it from my side. Thank you.
Thank you.
Thank you. The next question is on the line of Ashish Agarwal from Principal Mutual Fund. Please go ahead.
Yeah, thanks, sir. So just wanted to ask a couple of questions. First of all, on the largest client, what is the prognosis on that, on the client? Will that grow now into FY19? And number two, just a bookkeeping, was there any one-off in the margins in Q4?
No, there was no one-off in the margins in Q4. Q4 is 93 odd crores is all operating PAT. The one-off was in Q3. When we showed 99.4, there was 24.1 crores in Q3. As far as the largest customer is concerned, as I said, it will be flat to a decline. Flat if we win one of the deals in the pipeline, and if one of those deals don't happen and they get delayed for any reason, which is a way of life in our industry, then we're likely to see a year-on-year decline, which I'm not too worried because it's a portfolio rebalancing. Despite that, the growth rate which I've articulated will be true.
So, but the largest client will be in the current quarterly run rate, right? If you don't win that
That's right.
Incremental order.
That's right.
Okay, got it. Right, thanks.
Thank you. A reminder to our participants, anyone who wishes to ask a question at this time, they may please press star and 1. We have the next question from the line of Abhishek Agarwal from Finmart. Please go ahead.
Hello, sir.
Yes, hello.
Sir, congratulations on good set of number. So my question is regarding revenue growth. Like this quarter 4 is always a good quarter for us. So what is the reason for the flattish growth? And secondly, if you look at the EBITDA margin, we have performed quite well because we are pushing very hard to achieve this level of margin. So do you think that this level of margin is sustainable, or there is still possibility for expansion margin front?
Okay, so first thing is, as I mentioned, our top client, there was a drop in our top client revenues in Q4, which is why our revenues have come in flat quarter on quarter. So that answers one question. Second question, margins. Q4, there is a seasonality element where there is a disproportionate share of profitability drop to the bottom line from revenues because there is a seasonality element in our collections business because tax refunds happen in Q4 and people's ability to pay on charged-off debt is highest. So the margins, the EBITDA margins you see in Q4 is not representative of the EBITDA margins of the ensuing year. As I had mentioned, the EBITDA margins of Q4 were roughly 14.8%, and we are guiding the full year margins of EBITDA at about closer to 13%. And we fund as a management team, we believe that an EBITDA margin of 14% is something which is possible next year. Though we are guiding to a 60 to 80 basis point improvement, we believe 100 basis point is possible.
Okay, sir. And sir, as company is virtually debt-free right now, so company will start throwing lot of free cash flow. So what is our plan for future? Where will deploy this free cash flow?
No, I think that's what we have a dividend policy. If you were in the call, we discuss our dividend policy and our capital allocation towards M&A as and when we see relevant assets that fall into our sweet spot.
Okay. So currently we don't have any expansion acquisition plan which can boost our growth in the revenue?
No, nothing. As of now, we don't have any. We are looking at several targets across several industries and applications. Nothing which is even close to a closure at this point in time.
Okay. Okay, then, sir. That's fine, man. Thanks, sir.
Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for their closing comments. Thank you, and over to you.
Yeah, thanks. Thanks, everybody, for your time. I appreciate it. It's been a good quarter. It hasn't been a great quarter, but it's been a good quarter. But I think next year the outlook looks very good. And happy to take any questions that you might have missed on today's call. Ankur is available, and he can coordinate. He can respond or coordinate as you deem appropriate. And I look forward to speaking to you in 3 months. Thank you. Bye.